Hello everyone. Today let's see about the basic concept of macroeconomics. Normally, economics is classified into two. One is microeconomics and another one is macroeconomics. In this video, we discuss about what is macroeconomics and their basic concept. First, the term macro was coined by Ragnar Frisch in 1933, and the word macro was derived from the Greek word macros, which means long or large. It's called as aggregative economics or total economics. So whenever we involve ourselves with the aspects of the broader economic function of the nation, macroeconomics is the branch of study we are dealing in. And it also includes total income, total production, demand, savings, investment, and also total employment. So macroeconomics is a branch of economics and it helps to analyze and understand the performance and behavior of the economy as a whole. It focuses on the aggregate changes in the economy such as unemployment, growth rate, GDP and inflation. Professor Boulding defined macroeconomics as a theory, is a part of economics which studies the overall averages and aggregates of the system. Macroeconomics includes the following concept. First one, national income and output. So what is national income? It is the total amount of goods and services produced within a country during 1 year. And output refers the quantity of goods and services produced in a country of a farm or industry. And the general price level, it's the average all prices in the economy. And the next one, balance of payments, is a record of all international trade and financial transaction made by a country's resistance. Then balance of trade, it is a difference between value of a country's imports and exports for a given period and is the biggest components of balance of payments. So external value of money, the value of a currency expressed in terms of another currency is known as external value of money. Savings and investment. Savings is the income received by households that is not spent nor paid to the government in taxes. And investment refers creation of capital goods. It is a value of fixed capital assets stock produced in a country over a period of time. And the last one, employment and economic growth. Employment refers to the state of being employed and it is a relationship between employer and employee. Economic growth is an increase in the production of economic goods and services compared one period of time to another one. So next, subject matter of macroeconomics. The study of macroeconomics is crucial to understand the working of an economy. The subject matter of macroeconomics are described as below. And the first one, so macroeconomics helps in the national income analysis and it provides various methods to calculate national income. And the next one, it helps to determine the general price level. And third one, the factors that cause fluctuation in economic activities. For example, business cycle. So business cycle is a cyclical fluctuation of economic activities and it consists recession, recovery, prosperity and depression. It helps to calculate total savings and investment. The next one, balance of trade and balance of payments. These are the subject matter of macroeconomics. What are the importance of macroeconomics? First one, to understand the economy. Macroeconomics helps to understand the functioning of a complicated modern economic system. The main problems of macroeconomics are related to the total income, output, employment and general price level. Inflation and deflation. What is inflation? Rise in prices and fall in value of money is called inflation and fall in prices, rise in value of money is known as deflation. So both developed and developing countries are suffered inflation and deflation. So macroeconomics give the correct measurement and also provides a remedial measures to the inflation and deflation. Next one, to make international comparison. When we compare one country to another one, macroeconomics helps to compare the measurement of national income, output and employment. So it provides necessary for such condition. And the next one, formulation of economic policies. Economic policies cannot be formulated on the basis of performance of individual firms or industries. So the macroeconomic problems like poverty, unemployment, price stability, so we are no solved if we know them aggregates. Thus macroeconomics is useful to regulate the total employment, income, national income and to frame suitable national wage policies. Next one, to study microeconomics. Macroeconomics is indispensable for the study of microeconomics and the performance of the economy. Macroeconomics helps us to review the overall performance in the economy of different sectors. It is more realistic. Macroeconomic studies are based on empirical evidences or secondary data, so it is more realistic one. Dynamic aspects of the economy. Macroeconomic helps us to study the dynamic aspects or changes in the economy. It helps to the changes in the national income, employment, aggregate demand and supply, etc. The last one, analysis of unemployment. Macroeconomics is useful to analyze the problem and the solution of unemployment problems in the whole economy. So, what are the limitations of macroeconomics? First one, it gives more importance in the group of units compared to the individual units. So, the greater danger of macroeconomics is excessive generalization from the individual experience to the economy as a whole. And the next one, it ignores the welfare of the individual because it mainly concentrated in the group of unit. And it is difficult to measure aggregate variables. And there is a not necessary that all aggregate variables are not important. For instance, national income is a total of individual income. So if a national income grows up a country, it is not necessary the income of all individuals in the countries also rise. There's a possibility that rise in national income may due to the increase in the rich peoples of the country. And the next one, macroeconomic models are designed mostly suited to developed countries of the world. So the developing countries are facing various economic problems. So it is not benefit and it is not helps. Thank you.